All right, guys. So, welcome. Today, I'm gonna try some interesting, different type of content, a little bit of behind the scenes, what's going on in the actual market today. I'm not sure exactly the direction. I've been tinkering with a few ideas in my mind of where we could possibly take this channel, some different roads, maybe some market recap weekly, that type of thing. I'm not exactly sure exactly what all we can do. However, the market's obviously a broad subject, and I'd like to get into a little bit, maybe some tips, some advice, something like that. Um, anyway, so maybe some behind the scenes stories that you may not have caught if you weren't really paying attention that much today. So obviously, the markets have been taking quite a beating lately. The Nasdaq-100 fell over 3% today. Good stuff, fun stuff, guys, right? Anyway, no, obviously the market's been doing terrible the last couple of weeks, unless you've been shorting it, which congratulations, pat yourself on the back if you have. However, otherwise, the market's not been very fun lately. But some interesting behind the scenes stories I want to go over are, first, let's look at the government bonds here. So, obviously over the past, let's say, let's basically let's rewind it all the way back to 1980s. Paul Volcker took over, the Fed. You know, inflation was wild. He jacked up rates too. You could literally buy a government treasury for 15% coupon per year. So that would be nice nowadays. But unfortunately, you've basically got 0% for the last 10 years. In real terms, negative at some points nominally, or vice versa, switch that. But and literally negative in Japan. So still, which by the way, guys, if any money manager has you sitting in any instrument with a negative stated coupon or yield rather, you should fire them instantly, because what that's saying is that you are in writing guaranteed to get less than your principal back at the end of maturity, which would make 0 sense under any circumstances. So something to be mindful of. So obviously trying to rewind it again, going back to Volcker, because this is a very important theme that you got to keep coming back to. Bonds obviously and interest rates have inverse relationship. That's not an opinion. That's just a fact. That's not a conspiracy. That's just a method of how assets are priced. The discounting rate goes up, the present value goes down, especially on an asset that has a stated coupon. And obviously, the longer the duration, the more sensitive to interest rates you're going to be as a bond. So that's why I gotta keep warning. Be careful with these J and K junk bond ETFs, these HYG high yielding ETFs. They're very sensitive, more so than people might think, to even slight bumps in interest rates. So be careful there. Also, behind the scenes, so I want to take an interesting look at some good charts I saw today. Number one, we're going to go this high grade credit default swap index suddenly spiking here. Now, obviously, this is high grade credit default swap index, which means you expect it to be rather range bound and uninteresting. These are high grade bonds, credit that we're talking about here. These are very solid companies, AAA, AA rated bonds, A rated bonds, double B plus maybe, if we're feeling freaky. But you would expect this to be a very boring index, because who thinks they need credit default? Okay, so first let's go make sure we're all on the same page here. So a credit default swap index would be the price, essentially an indexed price of, let's say the aggregate cost of insurance for protecting against default events on high grade credit. So basically this is the, let's say a weighted average or so price of all the financial instruments out there, essentially in this default swap for the high grade market. So essentially this is the price to pay for betting, essentially insurance against the deterioration of balance sheet quality on very solid, stable companies. according to their credit rating. So you'd expect this to be uneventful, flat, range bound, not big moves either way, really. These would be high quality names, in the Dow, something like that, Johnson & Johnson, that type of thing. Pretty boring companies. And you'd expect this to sort of mirror the nature of the companies that they're following here. Very boring. Now, you would expect massive moves here in, let's say, the high yield market, because those are full of very companies in very precarious situations in terms of their, interest ratios, that type of thing, and their coverage ability here. Very susceptible to rising interest rates if we are talking more about the high yield market here. So this would be very normal, but this piqued my interest, and I think you guys might find it interesting as well. This is a big move here, and it's very sudden, and it contrasts highly with this down here. Now, obviously, it harkens back to this a little bit. Let's look at the 1 month here. Nasdaq-100 is down 7% almost. A lot of the gains have been wiped out this year. Now, is this merely emotional? Or a lot of the hedge funds have been getting just obliterated lately because they haven't had any hedges put it on. And then this happened. So, let me look at this year to date. Oh, that's gold. Never mind. Ignore that. Which is also unfunny. But anyway, so, this is usually seen when people get caught off their toes, or caught on their toes, whatever the saying is. However, you don't really expect to see that when the Fed has been forecasting for months and months and months and years, actually, the exact rate and pace of 25 basis point increments hiking, every few months or so, slow and steady, the turtle wins the race, right? I don't know why people are freaking out about particularly the Fed rising interest rates when, they've been screaming it through a megaphone for the past year and a half, 2 years. And again, if we go back to the bonds themselves, people were freaking out when it was 2.99 versus 3 on the yield, right? Now, this is interesting for several reasons. It's really important not to fall into these psychological traps. So why do companies selling products always seem to price their merchandise as X dollars and 99 cents as the cost on the label, right? What's the difference between X and 99 cents and X plus $1? The difference is only 1 penny, which you probably won't even pick up off the ground if you walked past it. So why do companies always price at 2.99 or X 0.99% or X and 99 cents? Because they know that it triggers an emotional, psychological, bias in our head that we can't, keep straight in our head the difference of 1 penny, because it looks more aesthetically cheaper, even though it's basically nothing. So same thing with bond prices or bond yields here on the treasuries. So, people thought the world was going to collapse if the 5-year went to 3% or the 10-year went to 3%. Oh no, the world couldn't handle it, but it could surely handle 2.99, right? So think about same sort of concept as pricing the products at think of this as if you were buying, something in the grocery store and someone suddenly changed the price from $2.99 to $3. Would you put it down and, run away because it was so much more expensive now? No. And it's not going to ding your wallet if you end up paying $3 for it either. Same thing with a company, right? All consumers have, assets and liabilities. Same thing with companies. They're not going to freak out. And realistically, if, 1 basis point increase on the 10-year, right? Now, obviously, 25, 50 basis points can make a difference over time if you keep stacking them and compounding them on a company's. It can provide some serious strain. but a 1 basis point increase on the 10-year is not going to suddenly crush the economy. So keep those type of biases in line and in mind and in check when you hear these things, especially when you hear people talking about it on CNBC, that type of thing, Bloomberg, any sort of business articles you might be reading. Keep that in mind, that there's a difference between sudden swings in price versus their actual effect on the underlying assets, who's actually getting hit by this in the long run. So keep that in mind. So after we keep that in mind here, there's another interesting picture that ties into this. Look at, I saw this recently. This is an interesting chart I wanted to show you. So keep in mind, interest rates were trending downwards from the 80s way here. And then, if you could plot also the interest rate on the 10-year, would be trending down like this. Then we get to here, 08. And you'll notice, obviously, the crash happened 08, 09. Interest rates dropped to basically zero. That means, and then for the past 10 or so years, they've been zero, basically, effectively on a real terms, not nominally. Well, even almost nominally, they're basically zero. Anyway, so companies for the past 10 years have had access to free capital, essentially, and they took advantage of it, as would anyone, getting free anything, essentially. So it's interesting to note that the slipperiest BBB rating here for investment grade has been the one that have been issuing the most corporate credit here. So, while you see here, A-rated has basically just, a little more than doubled or so. These BBBs, which you should always be skeptical when someone's on the fringe here between investment and non-investment grade credit here. What's the incentive to downgrade versus hold for these rating companies here, especially on the cusp? But you notice that solidly investment grade has essentially just doubled and stayed relatively flat. Meanwhile, the ones on the slippery slope have more than doubled from 2 to 5 trillion. This is a trillion on this right axis here. Keep that in mind. That should be alarming in and of itself. And I'm not certain off the top of my head, however, if we were to drop this down to maybe C rating, it might be exponentially higher than the BBBs, which should be scary. If we have the junk rated that's exponentially higher than the BBBs, and now we're starting to get the rise in interest rates, albeit only 25 basis points at a time, that adds on quick for these junk bonds. Especially in the energy sector, they've been getting crushed. These HYG, the J&K, high-yielding ETFs, be careful in those things. The liquidity is not going to be as strong as you might think, especially in a high-stress situation in the global economy, especially in a hawkish Fed cycle. With the rising rates, that hits them really quickly, guys. So be careful there. But anyway, so this has been just sort of a behind-the-scenes interesting look at some charts of the day, maybe charts of the week. I'm not exactly sure exactly the content route I'm thinking about taking this channel, but if you have any comments or suggestions, what you want to see more of, less of, content-wise, maybe some interesting stories of the day a few times a week, something like that. Interesting articles, charts of the day, charts of the week, sort of behind-the-scenes analysis. Lightning round companies, yay or nay, some company-specific analysis maybe. Just let me know in the comments, like or subscribe. I think that's the obligatory thing every YouTuber is supposed to say at the beginning and end of their videos. So hit that like or subscribe button and give me some feedback. Let me know what you guys want to see more of. All I want to do is help you guys make money and have some fun along the way, market memes, maybe, I don't know, something. Markets don't have to be boring. They can be funny and hilarious sometimes, actually. So let me know, and yeah, thanks for watching.